One day, Japan's stock market plunged to its lowest levels in decades, and the very next day, it surged dramatically. If you've been following the financial news, you might be wondering, what on earth is going on with Japanese stocks? In the world of finance, sudden shifts like these are often compared to a roller coaster, thrilling for some, terrifying for others. But what if I told you that these wild swings are not just random events? Instead, they are the result of deep-seated economic forces and strategic decisions that could have far-reaching implications for investors worldwide. The story of Japanese stocks isn't just about numbers on a screen. It's a tale of an economy that has been on a long and winding journey, one that has seen periods of incredible growth, devastating stagnation, and now a potential turning point that could either lead to new heights or another downturn. As we dive into this topic, you'll discover how the actions of Japan's central bank, the Bank of Japan, BOJ, and global economic pressures have played a pivotal role in shaping this narrative. But before we get into the nitty-gritty details, let's take a moment to understand why Japan's stock market is so crucial, not just to Japan, but to the entire global economy. What happens in Japan doesn't stay in Japan. The country is one of the world's largest economies, and its financial markets are deeply interconnected with those of the United States, Europe, and beyond. When Japanese stocks move, they send ripples across the globe, influencing everything from currency values to the stability of international investments. So, what triggered this recent volatility? And more importantly, what does it mean for investors like you? You may have heard of Japan's lost decades, a period of economic stagnation that followed the bursting of an asset bubble in the early 1990s. But the question today is whether Japan is finally breaking free from that long shadow. Some experts believe that we are on the brink of a new era for Japanese stocks, driven by significant changes in monetary policy and corporate behavior. Others, however, warn that the risks are still high. Which side is right? This video will guide you through the twists and turns of Japan's financial landscape, helping you make sense of the headlines and, perhaps, even spot some opportunities along the way. Don't miss any part of this video. Please like, share, and subscribe to Economy Explorer and stay updated on the latest in global finance. The role of the Bank of Japan, BOJ. For decades, Japan's central bank, the Bank of Japan, BOJ, has kept interest rates at near-zero levels, creating an environment where borrowing money was not just cheap, it was practically free. This policy, known as ultra-loose monetary policy, was part of Japan's long-term strategy to combat deflation and stimulate its sluggish economy. Investors worldwide took advantage of this by engaging in what's called the carry trade. They borrowed yen at these low rates and invested in higher-yielding assets overseas, earning profits from the difference. But here's where things get interesting. Recently, the BOJ made a surprising move by raising interest rates for the first time in years, and the market didn't take it lightly. When the BOJ announced this unexpected hike, it sent shockwaves through the financial world. The yen, which had been weakening due to the ultra-loose policy, suddenly surged in value. Investors who had borrowed in yen to fund their global investments found themselves in a precarious position. Their profits were being squeezed, and many had no choice but to unwind their carry trades quickly. This led to a massive sell-off in Japanese stocks, causing the market to plummet. But what does this mean in the grand scheme of things? The BOJ's decision wasn't just about controlling inflation, it was a signal that Japan might finally be ready to step away from its long-standing policies and move toward a new economic era. The global ripple effect. As Japan's stock market plunged, it wasn't just local investors who felt the impact. The repercussions were global. You see, Japanese investors hold a significant portion of foreign assets, from U.S. treasuries to European bonds. When they started selling off their Japanese equities to cover losses or meet obligations, it created a ripple effect across international markets. Suddenly, bonds and other assets that had been considered safe were being sold off, leading to a broader sense of instability. It's like a line of dominoes. One falls, and the rest are soon to follow. This global interconnectedness of financial markets means that what happens in Tokyo doesn't stay in Tokyo. It spreads, influencing markets from New York to London and beyond. The BOJ's actions have introduced a new level of uncertainty into the global financial system. With Japan being one of the largest holders of U.S. debt, any significant changes in Japanese investment behavior could have far-reaching consequences. Investors around the world are now on high alert, closely watching every move the BOJ makes. The rebound, investor sentiment, and market recovery. Just when it seemed like the Japanese stock market was in freefall, something remarkable happened: a rebound. Within a day of the steepest drop, Japanese stocks bounced back, regaining much of the ground they had lost. This quick recovery left many scratching their heads. How could the market turn around so rapidly after such a significant drop? The answer lies in the psychology of investor sentiment. Despite the initial panic, many investors realized that the fundamentals of Japanese companies hadn't changed overnight. The massive sell-off was driven more by fear than by any real weakness in the underlying businesses. Savvy investors saw this as an opportunity to buy in at lower prices, sparking a wave of bargain hunting that helped the market recover. However, this rebound doesn't mean that all is well. The rapid recovery has raised questions about the sustainability of this growth. Some experts argue that the market's volatility is far from over, and that we could see more swings as investors grapple with the ongoing uncertainty. Corporate health and economic fundamentals. Let's begin by looking at what's happening beneath the surface of the Japanese economy. Despite the recent market turbulence, Japanese companies are sitting on an impressive war chest of cash, estimated at around $700 billion. This is not just loose change, it's a powerful reserve that gives these companies a significant buffer against economic downturns and the flexibility to invest in growth or return value to shareholders. The accumulation of such substantial reserves reflects years of conservative financial management, a characteristic deeply embedded in Japan's corporate culture. But why are these companies holding so much cash? It's partly a response to the economic uncertainty that has plagued Japan for decades, from the burst of the asset bubble in the early 1990s to the prolonged periods of deflation that followed. This cash hoard is a double-edged sword. On one hand, it represents stability and a potential catalyst for future growth through dividends, share buybacks, or reinvestment into innovation and expansion. On the other hand, it also highlights a cautious approach that some critics argue has contributed to Japan's economic stagnation. By hoarding cash, rather than aggressively pursuing growth opportunities, these companies might be missing out on chances to increase profitability and market share. This conservative strategy is part of a broader economic narrative in Japan, where caution has often been prioritized over bold action. The impact of a changing yen. Now, let's shift our focus to the yen, Japan's currency, which plays a pivotal role in the country's economic dynamics. The value of the yen has been a critical factor in Japan's economic story for decades. A weaker yen has traditionally been a boon for Japan's export-driven economy, making its goods more competitive abroad. But as the BOJ's recent moves have shown, the currency can also be a source of instability. When the BOJ raised interest rates, the yen strengthened sharply, catching many investors off guard. This sudden appreciation made Japanese exports more expensive and less attractive on the global market, potentially threatening one of the key pillars of Japan's economic success. The volatility of the yen doesn't just affect exports, it also impacts the broader economy in ways that are sometimes less visible but equally important. For example, a stronger yen can erode the value of foreign earnings when they are repatriated to Japan, putting pressure on corporate profits. On the flip side, if the yen were to weaken again, it could boost Japan's export competitiveness, but at the cost of increasing import prices, particularly for energy and raw materials, which Japan heavily relies on. This delicate balance makes the yen's trajectory a critical factor to watch in the coming months, especially as the BOJ continues to navigate the tricky waters of monetary policy. Demographic challenges and economic implications. No discussion of Japan's broader economic picture would be complete without addressing one of the most significant challenges the country faces: its demographic crisis. Japan's population is not just aging, it's shrinking, and this demographic shift has profound implications for the economy. With fewer young people entering the workforce and a growing proportion of the population reaching retirement age, Japan is facing a potential labor shortage that could stifle economic growth. This isn't a future problem, it's already happening. The labor force is contracting and companies are struggling to find workers to fill jobs, particularly in industries that require physical labor or technical skills. The demographic challenge is compounded by cultural factors. For decades, Japan's work culture has been characterized by long hours and a strong emphasis on loyalty to one's employer. However, this model is increasingly unsustainable as younger generations seek a better work-life balance and as the pool of available workers continues to shrink. Moreover, Japan's reluctance to embrace immigration as a solution to its labor shortages has further limited its options. Without significant changes, this demographic decline could lead to reduced economic productivity and slower growth, making it harder for Japan to sustain its current standard of living. But it's not all doom and gloom. There are signs that Japan is beginning to adapt to these challenges. Some companies are investing in automation and artificial intelligence to offset the labor shortage, while others are experimenting with more flexible work arrangements to attract younger employees. Additionally, the government is starting to recognize the need for policies that support working parents and encourage higher birth rates. Whether these measures will be enough to counteract the demographic trends remains to be seen, but they will undoubtedly play a critical role in shaping Japan's economic future. The intersection of corporate cash reserves, yen volatility, and demographics. As we look at the broader economic picture, it becomes clear that these elements, corporate cash reserves, yen volatility, and demographic challenges, are deeply interconnected. The decisions that companies make about how to deploy their cash reserves will be influenced by the value of the yen, which in turn is shaped by the BOJ's monetary policy. At the same time, the shrinking labor force will force companies and policymakers to rethink how Japan's economy is structured and how it can continue to grow in the face of these challenges. Each of these factors on its own is significant, but together they create a complex and evolving landscape that will require careful navigation in the years ahead. This interplay between economic forces is what makes Japan such a fascinating yet challenging market to watch. Investors who understand these dynamics will be better positioned to navigate the opportunities and risks that lie ahead. Potential upside. Reasons for optimism. Let's begin with the opportunities that lie in the Japanese market, especially for those who are willing to embrace a bit of risk. One of the most compelling reasons to consider investing in Japan right now is the significant cash reserves held by Japanese corporations. As mentioned earlier, these companies have accumulated an estimated $700 billion in cash, which could be a game changer if deployed effectively. Imagine the potential for shareholder returns through dividends and stock buybacks, or even the possibilities for growth if these funds are reinvested into innovation, research, and expansion. This financial strength provides a cushion against economic downturns and creates opportunities for long-term growth, particularly in sectors like technology, robotics, and clean energy, where Japan has a strong foothold. Moreover, Japan's ongoing corporate governance reforms add another layer of optimism. In recent years, there has been a concerted effort to make Japanese companies more transparent and accountable to their shareholders. This shift is slowly breaking down the traditional insularity of Japanese business practices and making the market more attractive to foreign investors. For those who have been hesitant due to concerns about governance and market accessibility, these reforms represent a significant step forward. Additionally, Japan's potential economic recovery from the COVID-19 pandemic, although slower than in some Western countries, could lead to a surge in domestic demand as consumer confidence gradually returns. This pent-up demand, coupled with the resurgence of tourism, might just be the spark that ignites Japan's economic engine once again. Risks to watch. What could go wrong? But with every opportunity comes risk, and Japan is no exception. One of the most pressing concerns is the possibility of continued volatility in the yen. The yen's value is a double-edged sword for investors. While a weaker yen can boost exports, it can also erode the value of returns when converted back to stronger currencies like the US dollar or the euro. Conversely, a stronger yen, as we've seen recently, can hurt Japan's export-driven economy by making its goods more expensive abroad. This currency fluctuation adds a layer of uncertainty that can be difficult to navigate, particularly for foreign investors who may not have the expertise to hedge against these risks effectively. Another significant risk is the potential impact of Japan's demographic challenges. The country's shrinking workforce and aging population are not just long-term concerns. They are already affecting economic productivity and growth. With fewer young workers entering the labor force, companies may struggle to maintain their current levels of output, let alone expand. This could lead to a vicious cycle where reduced economic activity further depresses the market, making it difficult for Japan to sustain any meaningful recovery. Moreover, if the government fails to implement effective policies to address these demographic issues, the long-term outlook for the Japanese economy could become increasingly bleak. Finally, there's the ever-present risk of external shocks, whether from geopolitical tensions, global economic downturns, or unexpected changes in international trade relations. Japan's economy is highly integrated into the global market, meaning that disruptions elsewhere can quickly ripple through to Tokyo. For example, tensions between the US and China, Japan's two largest trading partners, could have serious implications for Japanese exporters. Similarly, any major shifts in global monetary policy, especially from the US Federal Reserve, could lead to capital flows that destabilize Japanese financial markets. Investors need to be aware of these risks and prepared to act swiftly if conditions change. Balancing opportunities and risks. So, where does this leave potential investors? Japan's market is a complex landscape filled with both opportunities and risks. For those who are willing to dig deep and understand the intricacies of the market, there are certainly rewards to be had. The key is to approach the market with a balanced perspective, recognizing that while Japan offers unique opportunities, it also requires a careful, informed strategy. Whether it's navigating currency fluctuations, understanding the impact of demographic shifts, or staying ahead of global economic trends, successful investing in Japan will require both insight and agility. Ultimately, the decision to invest in Japan boils down to your risk tolerance and your ability to navigate a market that can be as unpredictable as it is promising. By staying informed and being ready to adapt, you can position yourself to take advantage of the opportunities that Japan's evolving economic landscape has to offer. And who knows, with the right approach, Japan might just surprise you with the returns you've been looking for. As we wrap up our exploration of the Japanese stock market, it's clear that this is a landscape defined by both challenge and opportunity. The recent volatility, sparked by the Bank of Japan's surprising policy shift, has sent waves through the financial world, leaving many investors uncertain about what comes next. But within this uncertainty lies potential that is rooted in the substantial cash reserves held by Japanese companies, the ongoing corporate reforms that are making these firms more investor-friendly, and the possibility of a post-pandemic economic recovery that could unlock new growth avenues. However, investing in Japan isn't for the faint of heart. The risks are real, from the unpredictable movements of the yen to the long-term demographic challenges that could weigh on the economy's future. Yet, for those who are willing to dig deeper and navigate this complex market with a balanced approach, the rewards could be significant. It's about understanding the interplay between economic forces, staying informed, and being prepared to act when the right opportunity presents itself. So, what's your take? Do you see Japan as a risky bet or a hidden gem in today's global market? We'd love to hear your thoughts, so drop a comment below. And if you found this analysis insightful, don't forget to hit the like button, share this video with others who might find it helpful, and subscribe to Economy Explorer for more deep dives into the world of finance.